Hello, everyone. I'm Peter Towers, Managing Director of ESS BIZTOOLS. Welcome to this webinar today, where we're going to look at the role that accountants can play in assisting retail or wholesale clients to be able to analyze their stock mixes and the various markups that apply to various categories of stock, and then see if the actual sales will be able to achieve the profit targets that the business has set. If you have any questions during the webinar, can you please type in your question into chat and I will answer it later on. If you're watching this webinar on the live feed to Facebook, welcome. I hope you enjoy this presentation today. Unfortunately, you won't be able to type in your question to me as part of the webinar broadcast. So if you do have any questions, please send me an email, peter@essbiztools.com.au, and I will get a reply back to you. Let's look at the composition of retail and wholesale businesses. Obviously, there's product supplies, but they're various types, aren't they? There's all different classifications. It's a very unusual business that's got all the same. When you look at stock, it breaks down into categories. Stars, great products to have. Everyone would love to have them. Unfortunately, it all varies. They've also got problem lines that might have been last year's fashion or a special purchase order that the business made that didn't quite turn out the way everyone hoped it would. Then we got cash cows. These are the products that have got to be in a store. So I'm using a corner store as an example today in the presentation I'm going to show you shortly. Cash cows, what are they? Well, they're things like milk, bread, newspapers, products that a corner store's really got to have. But I think they should be spread throughout the store rather than all sitting around the cash register at the front of the store. And we'll talk more about that in a little while. And then we got sludge, products that probably should never have been purchased. They've got a low volume and low markups. They're a nuisance. We really should get rid of them. Accountants need to develop a knowledge about the product composition within a business for giving advice as business advisory services, consultancy experts, or as virtual chief financial officers. I really believe you need to know how all this mixes. I knew nothing about this many years ago when I got involved in the meat industry. We had retail butcher shops, delicatessens, boning rooms, meatworks, of course, and understanding how it all fitted together was a great challenge. You can do it, and I think you need to be able to do this for various industries. So let's look at a stock matrix chart so that there's a clear understanding of what we're talking about. We've got the sales levels, high and low, of course, and we've got the margins, high and low. So the stars sit here as something that's a high volume and a high margin. That's what you want in your store. The cash cows are high sales levels. There's a lot of this product getting sold. Some cases it might be the biggest selling category. And but unfortunately, it's low margins. You got to have it, but you're not going to make much money without it. Then we got the problem lines. So they're low volumes, but their markup can still be high. And then you got sludge. So they're low volume, low markup. You'd wonder why anyone ever purchased them in the first place. But nearly every business ends up with some sludge. And the real challenge is being able to get rid of it. Let's look at what else is involved in a retail or wholesale business. There's a team of people. So we need to make sure that in our pricing, we're factored in the labor costs, the people who are working within this business. What's their working hours? What's their remuneration? What's their holiday arrangements, their labour on costs, superannuation, any other penalty payments? We need to look at the overhead expenses. What are they going to be for the 12-month period? Because we're trying to set a pricing structure here so that you can help your clients set these structures. So let's look forward for 12 months. What do we think the overheads are going to be for this business? Look at the profit and loss account, of course. And what's the targeted profit? Because we're trying to make enough sales here to cover the cost of goods sold, the labour, the overhead expenses, and make a profit in a retail environment. I think it's best based on a return on what you and the client believe is the investment in the business. But you could just slot in a figure, if you like, $200,000 or whatever the owner would like you to do. And let's look at the marketing selling dilemma that businesses have, that your clients have. And I'm now talking to you that you are the chief financial officer or the full-time accountant. I know you're doing both of those roles as a virtual CFO or a virtual accountant, depending which title you prefer. Most retailers can not only sell their star items, most need to also sell cash cows. And most businesses need to be able to sell just more than the cash cows. You can't run a business selling just cash cows. In most cases, that won't give you enough money unless you sell a real lot of it to cover your overhead expenses and to make a profit. And if there's problem lines, and most businesses seem to have these also, in lots of cases, it's last year's fashion, but it might have been a food product that someone's bought in and that hasn't worked. The market doesn't like it. And if it's a food product, it's probably got a fast expiring shelf life. So what's going to be done about it? What can the business do? These are real life questions that most of you have never seen if you haven't done any other work other than annual accounts and tax returns for your clients, because this is happening on a day-to-day basis. But if you're offering a virtual CFO service, you are going to be involved in these sorts of situations. And sludge, well, I think the only way we can deal with this is to get rid of it as quick as possible, because it's taking up floor space, it's eating up costs. Let's get rid of it. So we've developed a product mix markup chart to help retailers have a better understanding, to help you being able to make some contributions as to what could be done to help your clients. Now, part of it could be more in-store promotions, for argument's sake. And we're going to use a corner store as an example. So cooking some food, having some nice food cooking smells throughout the store can encourage people to buy some of it. Give them a taste. If you're running a bar or a bottle shop, wine tasting is a great way to get people interested in some of the products. Your role's not there to be doing the wine tasting, though. It's to help your client calculate what the result will be by utilizing various strategies. And I'm going to show you some of those shortly. I think one of the real strategies that you should be talking to your client about is, where are the cash cows? Some years ago, I used to wander down the hill on a Sunday morning to the local corner store and buy the paper and whatever else. If my wife wanted some eggs or milk, I'd get them while I was there and walk home. And a guy bought that store that I knew him. And I'd go down there on a Sunday morning. It was the only time I ever went to that store. And he had some very nice ham off the bone he was selling there. And he had it in a refrigerator virtually at the front cash register where he was sitting. He was surrounded by the newspapers, by milk, which he also had in that refrigerator cabinet, bread. You really had trouble seeing him because he was surrounded by all these items, which I could only describe as cash cows. They weren't stars. If you have a look at the supermarkets these days, their cash registers are also surrounded by products. You can bet your bottom dollar they're star items. They're not cash cows. You won't see milk and those sort of products there. So I said to him, why don't you space these cash cows around the store? He said, oh, a lot of people just come in to buy them. I said, that's great. Let's try to encourage them, to bribe them into buying something else. Put your cash cows next to a star. You got some wonderful cut ham. Why have you got it out here? Put it back into the store. People know you got it. You're famous for it. Put it back into the store and perhaps have someone there carving the ham. Perhaps you should have a cash register operator working here on a Sunday morning, and you should be in there carving the ham and perhaps making up some food parcels that people could eat. You're a bit of a showman, so get in there and do that. You're wasting your time on the cash register if you want to sell more products. And you've got some beautiful organic tomatoes. Why don't you spread them next to a cash cow item and put them around the store? Make people walk around. They might buy some other things. They might buy some peanut butter or Vegemite or jam while they're here. I can only assume they're star items. So think about how you set up your store. So locate the star products in close proximity to cash cows. And the problem mines, well, I'd put them around the cash cows also. There's a better chance that someone will pick them up and say, oh, we might buy this. We're not worried it's last year's colours, or it mightn't be a famous food product, but people might buy it. And it's also important to vary the markups. Just because you think something should only be marked up 60%, perhaps the market will bear it at 70%, especially if there's some promotions and maybe in-store promotions built around that product. And this is not a job that's only done once a year. I think it's a job that probably needs to be reviewed at least every month, where you sit down with your client and say, well, here's the actual results. Here's the forecast we did. We haven't made enough gross profit to achieve your profit. Therefore, we need to do some tweaking on the pricing. And that's what I just said. Just checking I got no questions at this stage. I think clients should be encouraged to invest in cash register software products which will produce sales, gross profit, and gross profit percentage results for each component. That sort of software is now available. It gives a lot of information that you or their office manager can be analyzing. So I think this is what a virtual CFO role is when it comes to helping retailers and wholesalers, being available to dig down into trying to work out what the composition is of what they're doing. The aim is to ensure that the overall product mix that is being sold is going to be of sufficient quantity and markup that it will generate the profit that the business is budgeting for. And in most cases, management needs assistance in that. So I'm now going to go to our ESS BIZTOOLS website, first of all, and show you the material which we have. For this product package. And what I'm bringing up for you is the product package for the calculation of retail pricing calculation. I've already set this up for you, so I can just explain it to it. So I've called it Top Class Corner Store. There's some instructions as to how to use this Excel spreadsheet, which I think is straightforward, but if you have any problems with it when you're utilizing it, please contact me. We start with the labor on cost. What we've done is set this up so it's branded top class corner store, prepared today. And we have classifications for full-time staff, part-time staff, and casuals. And within each of those, we have provision for 6 classifications. And these are classifications based on what their on-cost calculations are going to be based on. So for example, the first one here in A1 is the manager. And we've said this guy gets 25 days a year leave. He doesn't get paid holiday pay. He gets the statutory and personal carers leave at 10 days, but he gets superannuation calculated at 12%. I haven't put any payroll tax in for this business. So I don't think they'll be at that level. Work care, we say it's costing 2%. He's going to have 5 days training a year. And the business is based in Queensland. And when I've inserted Queensland, our link to the long service leave calculator says we should be providing 4.33 days a year in a calculation. Now that's the same on-cost type calculator we use for our tradies and manufacturers charge out calculations, and the same with professional service firms. And these additional costs and or absence from work are important when it comes to recording their productivity. We haven't recorded productivity for retail employees because most people don't do that. In fact, I haven't seen a retailer that's ever done it. So, but we've used the same basis. We then insert that the business is operating for 260 days in the year just by inserting the number of weeks and the days per week. So the system's then told us this guy is having 50 days off during the year. So his productivity is going to be over 210 days. Those percentages are then important for working out the labor on cost. There's nothing for holiday pay because we're not paying it to him, but long service leave, then super, there's no payroll tax in Queensland for this business. There's no holiday pay loading. So the total on cost, when it's expressed on an annualized salary, will work out at 15.67%. If we look across here, we got the assistant managers. They get only the traditional 20 days annual leave, but they get the holiday pay loading of 17.5%. They get super at 10, not 12%. They're going to have 4 days for training. They're in Queensland, so they're getting the long service leave. So the calculation there is that their on cost is 15.01%. And then we have the shop assistants. They're slightly different because they're having 3 days training a year, and their on cost works out at 15.01. In fact, they're very, very similar to the category before. Then we got the office manager, and there not many variations there. 20 days annual leave, the holiday pay, and so on. Then we got provision for the permanent part-time employees, shop assistants. And here, because they're part-time, we have to insert the number of working days that they're going to work in a year. So we're assuming in that calculation, this group of people are working 4 days for 30 weeks. So they're working 30 hours in a week, so that's 900 hours in the year. Now, if you had another group of people there who were working only 600 hours in the year, you would set up category B2, just so that the system is able to pick up all the details when we do the labor cost. So hopefully you understand how that's been worked. And then we go through there, we've got no more in the in the part-time category. Then where we got some casual employees and got their classifications, and all we're recording here is superannuation and work care or payroll tax if it applies, how many hours they work in a year, and the system will then do the calculations. So we now link through to the labour budget. We've got one manager at $125,000. The system's calculated the labour on cost and the total labour cost. Then we got the assistant managers, same sort of thing, the shop assistants and the office managers. So they're the people in the full-time permanents, and there's 10 of them. We got the permanent part-time staff, we got the shop assistants, and there's 6 of them. And then we got the cleaners, there's 4 of them, they're the casual people. And so we got 20 staff in our payroll, including on cost, is going to be $1,019,000 for the year. The budgeted overhead expenses are the next category. Now, I've taken the shortcut and just said general overhead, $495,000. In actual practice, I think you'd be listing what those overhead expenses were so your client could read them. Then we got the financial analysis. First of all, what's the return on investment that I talked about before? I've said this business is worth $500,000 and that the owner wants a 20% return. Obviously, you can change those figures. And so we're looking to target a $100,000 profit. So the system's then done the calculations. The total labour cost was $1,019,000. The overheads are $495,000. The targeted profit's 100. So we need to generate a gross profit of $1,614,000. What's management's expectation? They're running a corner store. What do they expect to make? I've put 35% into there. I note that benchmarking.com's 2020 report for corner stores has got a result of about 31.4% on average. So this is hopefully going to be a slightly better than the average according to benchmarking.com. But to do that, we're going to have to generate sales of 4.6 million. So that's the background. We've put it all together. You're the accountant. You're talking to your client or a manager of your clients, and we're now going to go to the sales mix. So the system's already badged this sheet that we're working on. And this first group of figures, which is part of what is example 1, which comes across to here. These are the figures that I've sat down and talked to management and said, well, tell me what you're doing at present. They've told me that and I know from the accounts, the turnover is $3.7 million. So let's just go through, and they say, well, we got these star stocks, and I've just called them star category number 1. You've got plenty of space here, 46 categories you can put in. So you could go through and expand it a lot more than what I've done. So they reckon out as their first group of star stock, they buy 250 grand's worth in a year. They mark it up around 80%. So that should mean that they're generating sales of 450,000 and making 44% gross profit percentage on those purchases. They got some second categories of stars. They spend 150,000. They're marking that up by 70%. So they should be generating sales at 255 and so on. Then we got a third group of stars. They got 200, but they can only mark that up by 60%, they think. We got these cash cows. The first group of them, they can only mark up at 40%, and that's 695 grand they spend on those. So overall, they're only generating a 29% gross profit. And a lot of your clients, I don't think, really appreciate the difference between markup and gross profit. And actually, in fact, we've got a chart here, which I'm coming to in a moment, just to make sure they clearly understand that if they mark something up by 50%, it's what its gross profit percentage is a lot less than that. It's 33 1/3%. Okay, so cash cows number 2, they've got 600 grand of them. They're only getting a 30% markup. The problem mines, these are whatever you want to call them. Last year's shouldn't have bought them, whatever. We got 490 grand's worth of them. They think they can only mark up 45%. And the sludge, every business has got some of this, I think. We've put in at 230, or they've told me 230 grand. They paid for that. They can only mark it up about 20%. So let's look at the result. If we just follow down the bottom here, please ignore the other 2 columns at this stage. Their sales are 3.7 million. Their gross cost of goods sold are 2.6 million. So they've got a gross profit of 1.1. That's an average of 30.54. And then we take off their budgeted overhead costs of 495 and the labor on costs of 1,019,000. So actually, one of the trouble with Excel, the minus signs are very small, aren't they? And we can't get brackets to come around it, but that's a minus figure of $365,000. So that's where we are at present. No wonder they're talking to you. And so we've now got to give them some advice of what they're going to do about this. They're showing an average 30.54. If they think that's the biggest markup they can get, the brute reality to them is they've got to sell an extra $1.5 million worth of stock at that markup to earn their 100,000 profit. And this is really now digging into the figures. And this is the work that goes on as a CFO. I was a CFO, company secretary in a listed public company. We were in the meat industry. We had retail butcher shops, delicatessens, and we had to do this sort of work to help the managers. I had to make sure the accountants, I had 13 of them around Australia working for me. I had to make sure they were doing this with their 20 or 30 retail butcher shops that they were responsible for, and delicatessens and other boning rooms, etc. Okay, so the first attempt at trying to fix this, I said, okay, if we started doing some in-store promotions, could we sell a bit more of this Star One? Could we move the sales? Could we move what we need to buy by 50 grand and get a 10% higher markup? Oh, yeah. If you've dealt with managers, you'll know the whinging you'll get. I said, well, we can't keep on going the way we're going. We're losing 350 grand. So let's get our act together. We've got to do something positive. Star number 2, let's move it up that we'll buy 200 grand's worth and we'll try to mark it up an extra 5%. Star number 3, let's move it up 100,000 and we're only getting 2% more, 62%. This is the reaction you get from managers. They don't want to do anything. And what you've got to keep on coming back to them is the reality. Hang on, we are currently losing, I said 350 before, it's worse, 365,000 we are losing. What are we going to do about it? You're going to be out of a job, quick smart. I wonder you're not already. Cash cows. Well, we got 695. Yeah, well, we don't want to buy any more of it. We might be able to nudge the price up 1% in the markup. The cash cow number 2, yeah, well, let's try to get out of them if we can. So we'll drop our purchases back and only buy 550 grand and hopefully we haven't got a mutiny of buyers who walk in, see we haven't got it and walk out with nothing in their hands. Because that's one of the problems that your clients will throw at you with these cash cows, and they're real. Some people are initially only going there to buy that cash cow product. The art of running these businesses is to be able to sell them something else while they're there. But they'll be worried that if it gets round on the grapevine that they no longer sell a particular brand of milk or haven't got the newspaper or whatever, people won't come to them. So you've got to weigh all this up. They can get quite emotional. So I'm saying there the markup remains the same. It's still 30%. And then we got the problem mines. Well, I don't know what you can do there. You don't want to buy any more of them. You want to get out of it. So 490 grand. And I think we've already bought them. They're sitting in the shelves. You wouldn't be saying, let's go out and buy them. But I'm suggesting here, come on, let's really try to use our brains, position the stock around the store, perhaps have some promotion. Could we nudge the price up 5%? So we get a markup of 50% instead of 45. And well, the sludge items, we want to quit them. So in fact, we've all agreed we'll lower the markup to try to get them out of the store. And everyone's promising everyone else that they'll never buy that stuff again. Incidentally, just watch computer reorders automatically occurring. I've seen situations where managers have worked and worked and worked. One guy over 2.5 years to clear some stock that they virtually couldn't even give away. And I happened to be in the store, in the office one day, quietly working away in the boardroom, which was my permanent office in that client. And I hear this outburst outside, and I'm being very kind calling it an outburst. He was going off his rocker. And I went out and I knew this manager very, very well. We used to live in the same block of apartments when we were all bachelors. And I said to him, "What's wrong, Jim?" And he said, "I've been trying to clear," and I won't use the adjectives, of course, "I've been trying to clear this stock for 2.5 years. I've even paid the team a bonus to get rid of it. We originally had 24 of these things. They cost us, I think it was $400 odd each. They were huge vases. And this was a jewelry business. And it's taken me 2.5 years to get rid of them. And here they're back." And what had happened, the computer just automatically reordered it. So you just need to watch that, because he definitely would have called that sludge, but he had a better adjective that day, which I won't repeat. So I'm saying there, you may have to say to the client, well, let's drop the price. We've got to get rid of this stuff. It's driving everyone mad, and just make sure we don't reorder it. So what's the result of that? Well, the turnover's gone up to 4.1 million. The cost of goods sold's gone up, of course, 2.765. But when we look at the overall results, we're still losing $172,000. And that's when you should start getting management serious. They're either going to throw the towel in and go and get another job, or they're going to really look at what they can do. So that's what the third example here is trying to show you. We've now talked a lot about in-store promotion, cooking. We're a corner store, so cooking, perhaps getting some celebrity into the store. Maybe that's going to cost us a few dollars. Maybe we can get the wholesalers and the distributors to assist by making some product. You've got to, if your client's not thinking on these lines, you've got to encourage them to start thinking as to what else could be done. So I'm saying here, let's go for it. We're going to go from 250,000, which we are at present. We're going to sell 450 grand of this, and we're going to get our markup up from 80% over here to 95%, and see what that's our aim. That's what we've got to try to do. Get the team in and train them. They've really got to push these products. Stars number 2. We want to move the sales from 150 grand the cost of goods sold, up to 300 grand, and increase the margin from 70 to 85. And so on with the others. But we've still got the cash cows number 1. We've still got that at 695. We haven't varied that. But we got that 1% extra markup. The cash cows number 2, hopefully we're now able to reduce it from a 600 grand purchase to a 500 grand purchase over the year, but we might be able to just move up the margin by 3% to get 33%. The problem lines, well, they're still at 490 grand, but perhaps we've been able in our calculations here to move the markup up to 52%. That might mean some clever layout of the store, moving them around, having promotions, putting them right in people's faces when they go to get their newspapers, or whatever. The sludge, well, we might be able to do much about the sludge. We just want to get out of it. So we've still got the same figure, obviously, and an 18% markup, which we've reduced by 2%. Now, what's that going to give us? Well, our turnover is now 4.6 million. Our cost of goods sold are 2.99. Our gross margins 1,638,000. That's an overall 35.4%. Our overheads are still 1.5 million. Now, we may have added another few grand in there with some guest appearance for people that may have had to pay for, but your client should be talking to the wholesalers and the distributors and trying to get them involved. And if they don't ask, they'll never know. I've had clients that have said to me, oh, we were going bad, and then we noticed one of our competitors has got a big promotion on, and we find out that the wholesaler went in on a 50-50 basis or 100% basis. I said, did you ever ask? No. Well, you've got to ask. So this way, we're going to get a forecast profit of 125 grand. And in fact, what our system now says is that's a 35.4% GP percentage. And in fact, they could reduce turnover now by 71,000 and still earn our 100 grand target profit. Does this help you in talking to your clients? I think it does. I've used this approach. When I was the CFO of a listed public company, we didn't have Excel spreadsheets. I can assure you, we had dissection sheets, and we used to do this on dissection sheets. Sit there and calculate it, and then make sure that the managers or the key salespeople in organisations understood what we were trying to do. Now, you're the accountant or the CFO. You're not making the management decisions. Of course, you're not there day by day running the business. But what you're trying to do is to use the figures, to use the calculations, to give them some indicator of how they might go about things. So I'm just going to check and see if any of you have got any questions. I haven't got any questions. I hope that you've understood what I was trying to do there. I mentioned a gross profit markup. We'll just finish with this and show you. That's just a chart where we've put in place and saying, because I found people make mistakes. In fact, I had a client who used the markup percentages thinking they were used the gross profit percentages instead of the markup percentages, and he got into a real mess. He was marking up with what in fact were the gross profits, so he was getting nowhere near what he thought he was getting to. So that's why we've included that chart. And there is a long service leave summary which we're linking to for the. That's why you insert the state, and it will then tell you what the long service leave. Most states are 4.33, of course, but there's a couple at 6.5, as you'll notice there. Okay, so that's how we use this material to analyze where we're going in the system, to analyze the product package. I'm just trying to find the link to our website, and I can't quite find it on this screen, so I don't know what's. Bear with me one moment, thanks. I mightn't have. No, I can't do that. So what I'm now going to do is, I guess what I'll do now is go back to the PowerPoint slides, and we'll continue on from there. ESS BIZTOOLS has got a discount sale on. In fact, that date is wrong. I'm sorry. That's this should be the 6th of September, not the 6th of August. That's come and gone. The innovation package, which includes our research and development package and the accelerating commercialization grant, the early stage innovation state grant. I'll say that again. The accelerating commercialization grant and the early stage innovation company status, how you go about getting the due diligence report prepared. We've got full packages on that. So you can subscribe to that for $2,500. The starter package, which is the recommendation we make for people who are just starting on business advisory services, you can have a 12 months access to that for $999. That's a 50% reduction. The gold package, which we're now calling advanced package, $3,250. Now, this includes everything else. So it includes what's in the innovation package. It includes what's in the starter package, and the Chief Financial Officer service, which is also included in the advanced package for $1,375. If you wish to find those packages, please go to our website, www.essbiztools.com.au, and click on to the 50% discount details, and you can proceed from there. We've also developed a white paper, Diversifying Accountancy Services Why. If you'd like to download that, please go to our website, www.essbiztools.com.au, and the free white paper pop-up will appear, and you can log on to that to get a copy of our white paper. Our upcoming webinar in this series, which we've been running throughout July and August, is looking at the business health checks system, which we have implemented. We have it operational for 5 different industries. We're going to showcase pharmacies and supermarkets on Tuesday, the 31st of August at 12 noon. And again, this is giving you tools that you as accountants can utilize to really offer these business advisory services for the marketplace. So Chief Financial Officer services are not just producing profit and loss accounts and balance sheets. You have to dig into the financial results and what happens within the business. So it's the costing information, it's the price setting information. In most respects, accountants in public practice start with all this having already occurred. But if you were working in a larger organization in the commercial area, these types of calculations and deliberations would be being undertaken, and you would have involvement with them as the Chief Financial Officer. And this is the type of service which we're trying to assist you to be able to perform to your SME clients. So the business health checks is also very important because it's a benchmarking type comparison, but it's set up so your clients can be doing it month by month. In fact, some people are doing it week by week for a part of it, so that they've got real data in front of them that they're looking at, and they're looking for the variations. If the average sales running along at $51.23 in a business, and this week it's coming in at $26, management will be reacting. But do your SME clients really see that? Is it staring them in the face? Are they doing this already? This is the challenge. Going back to the very beginning of the business process and making sure that they are getting the appropriate information coming through to them. Because it's too late, 14, 15, 16 months later, if you're doing the financial accounts, to be able to saying to them, oh, gee, your average sales dropped during the year and your gross profit percentage also dropped. It's too late. It's all occurred. And in some cases, this can happen without anyone really being aware in the business. So that's what we're going to be looking at. Well, there's the registration for the upcoming webinars, which I just mentioned to you, so on our ESS BizTools. If you're interested in getting any more information, please send me an email or visit our website. So an email to me is peter@essbiztools.com.au. or you can go to our website, essbiztools.com.au, or send me, or make a telephone call to me, 1-800-232-088. If you're in the areas around Australia that are subjected to the lockdowns, we are thinking about you. Please stay safe, and hopefully all of your team and your clients are also safe. Thank you for being with us today, and I look forward to talking to you again next week when we're going to look at the business health checks. And if you need any more information on the services that are contained within ESS BizTools, please do not hesitate to contact me. So on that note, please have a great day, and I'll be talking to you again in the not too distant future, I hope. Thank you. Goodbye.